Serving over 100 countries, Polaris Industries Incorporated operates in the recreational vehicle industry within the cyclical consumer goods and services sector, as well as various subsectors of the work and transportation industry. It is a global power sports leader which designs, engineers, manufactures, and markets vehicles in the off-road snowmobiles, ORV, motorcycle, and global adjacent markets. Additionally, Polaris produces parts, garments, and accessories for each of the aforementioned segments and has a line of portable power generators. Its competitors by capitalization are Honda, Deere & Company, Suzuki, Yamaha, Kawasaki, Arctic Cat, now part of Textron, Harley-Davidson, and Bombardier Recreational Products. The company provides utility task, UTV, and all-terrain vehicles, ATV, in four-wheel configurations with 1, 2, and 4 seats for recreational, utility, and military use in the ORV market. As well as kits to transform off-road motorcycles for use in snow, and of course their longest standing product, snowmobiles. Polaris competes in the on-road motorcycle market via Indian and with the autocycle, Slingshot. The Global Adjacent Markets segment is an amalgam of divisions and strategic alliances which produces increased opportunity for innovation by sharing technology and R&D investment. The Global Adjacent Markets segment is diverse and includes off-road aftermarket parts for Jeeps and trucks, commercial and industrial electric vehicles in Europe and North America, a business vehicle in India which triples as family transportation and a home or business power generator, and includes relationships with work utility vehicle rivals Bobcat and Kubota, as well as Daimler and Hyundai. This is the most lucrative segment of the Polaris portfolio, as it not only encompasses zero-emissions vehicles for commercial and industrial use, as well as the means to identify its brand in developing countries, but also exemplifies the growing trend of arm's-length relationships among would-be competitors. To comprehend the scope of these arm's-length relationships, one need only look to the successful 2013 partnership between Ford and GM in the creation of 9 and 10-speed automotive transmissions. These relationships reduce R&D investment and time to market by providing reliable, high-tolerance components, providing manufacturers with the means to differentiate according to vision and in-house technical capability. Polaris engineers and manufacturers in the United States of America, Mexico, and Poland. It performs R&D in the United States as well as in Switzerland. It distributes worldwide with facilities in Europe and Australia, which act as regional administrative centers as well as providing service and technical training for dealerships. Product and information are provided by an independent network of distributors and dealers, as well as call centers and e-commerce sites. Quality, performance, maintenance, and value are the four concerns of any durables buyer. Depending on the use of the product, every item that is sold by every manufacturer is tailored to meet the needs of a particular group of consumers. The one that introduces an award-winning idea is quickly copied by its competitors. Continuous improvements in design, service, and marketing are required. Polaris's ORVs have been in the fight for top market share for years. Their recent recall problems have left customers and dealers questioning their quality. Polaris must reestablish their commitment to this market if they wish to leverage this part of their product portfolio. Bombardier holds a comfortable 14% lead, projected in 2017, over Polaris in snowmobiles. This market is static, but Polaris has had the most share gains since 2010, testament to their premium product mix and innovative ability. The North American on-road motorcycle market is clearly led by Harley-Davidson, but the 2020 emissions standards are causing them havoc. Indian is prepared for this, as are the Japanese. Considering that Harley's reputation is built on image rather than quality, 2020 could propel Polaris into superstardom should they continue to outpace Harley in quality, performance, maintenance, and value. Polaris dominates grueling high-performance UTV race series. Feedback solicited from these independent sources because of their willingness to adopt and adapt technological innovation to their needs is paramount to Polaris. It provides direct contact with their most ardent proponents and competitors, data from extreme operating conditions, and awareness of and unique solutions to unforeseen problems. Add to this that Indian has factory-sponsored a team that in 1 year has devastated a racing genre that Harley-Davidson traditionally dominated, American flat track, and you are left with an engineering and administrative team's best-case scenario. Marketing and research that is specific to a product but can be leveraged into a broader market on one hand, and the public emasculation of arch competitors on the other. Polaris's acquisitions have focused on broadening market penetration, diversifying into technologically similar markets, and venturing into new markets which allow them to flex their technological adaptability. These have endeared them to North American markets and provided penetration into Europe and India, with the hope that they will expand into Bangladesh, Nepal, Sri Lanka, Africa, Central America, and China. 2014 marked Polaris's 60th anniversary of innovation. Current CEO Scott Wine joined in 2008, and since then Polaris has secured contracts with the US, Canadian, and German military for ATVs and UTVs, bought over 14 strategically situated companies, entered into several strategic alliances, and introduced the first 2- and 4-seat UTVs, mobile connected systems for UTVs and on-road motorcycles, and lithium and electric power units into UTVs. Through their strategic alliances, they have co-developed UTVs for heavier work applications, and co-designed customized versions of off-road SUVs for the Chinese market. The future is exciting due to the possible outcomes from its purchase of several companies that have experience with electric motive power and their application in work and transportation. All of Polaris's markets are highly competitive, and its competitors are more highly capitalized. This increases the chance of disruption because it affords them greater latitude when creating marketing strategies and bringing new products to market. Polaris's core North American ORV market provides recent examples. Promotions which disrupt normal sales patterns cast aspersions on management from short-term investors. Increasing standard warranties to 3 years causes dealerships and customers to question their brand loyalty. A solid distribution network, one with dealer advocates who believe in the product, becomes essential. Except for Indian dealerships, which sell only Polaris products, most dealerships are multi-branded. This introduces an element of uncertainty even with products as highly regarded as Polaris's, as dealers can easily switch allegiances from one manufacturer to another. While competitors have been using promotions to eliminate 2016 inventory in 2017 Q2, Polaris has been planning the introduction of a vastly superior product mix. They dealt with a substantial portion of last year's inventory in 2016 Q4 in anticipation of their new order inventory system. This has left them in the enviable position of having a vast array of not merely new products being introduced for the 2017-18 season, but the implementation of a price ladder strategy that integrates with their innovative prowess, starting with a luxury model for upper-end consumers and progressively translating its standard list of features into options that lower-end consumers can add to a base model. This arises from the fact that the industry is highly promotional, with the corollary being a consumer confused by marketing as opposed to being drawn into a showroom. Polaris uses their share lead in core markets in conjunction with a vast array of upgrades to specify a clear pricing structure which clarifies consumer buying decisions. They will only use promotions when necessary and will not do so on products which are core leaders. They have instituted one of the most advanced online research tools available, both online and in-store. They have a free mobile app which can track other riders, show a vast array of riding trails in North America, and can be integrated into their ORV and Indian lines. They are concentrating on providing quality educational materials, extended service 24/7, and providing social content to dealers so as to present a consistent image. It is believed that reinvigorating their image will provide them with mid-single-digit growth, the industry's overall forecast, which is sufficient to regain and surpass historic margins. Polaris's markets are generic, with many direct substitutes, but the functionality is discrete and tailored to the consumer. A small fishing boat owner does not consider the Polaris Indian trade-off. An affluent boat owner is likely to consider buying a personal watercraft versus an ORV. A current motorcycle driver is more likely to buy a second unit than otherwise. Aging riders may retire to drive a Winnebago, but they are just as likely to own one of Polaris's products as well. Riding is a lifestyle. Polaris is a global leader in power sports because buyers know that no other vehicle can perform the same task as effectively. Polaris understands their demographics and has targeted agriculture, hunters, and multi-acre homeowners in North America, accounting for approximately 26 million people in the United States alone. Polaris offers these groups an affordable option to buying a full-size truck for work duty. A half-ton truck, Ford's F-150 for example, can outperform any of the utility class offerings in sheer power, but they lack maneuverability and the ability to operate in constrained areas. This makes them harder working, but not as adaptable nor as fun for twice the price. Similarly, electric power is a lifestyle choice that consumers make for which there are few alternatives. The push to reduce carbon dioxide emissions in European cities through restricted downtown core access is gaining momentum. Diesel is banned in some European cities, and the UK is talking about no new diesel or combustion cars by 2040. The major automotive manufacturers have similar offerings to Polaris's Goupil and Axim, but few have the diversity of Goupil's industrial truck offerings. This leaves Polaris with a market niche in Europe for which little competition exists, as of yet. Given the level of competition in Polaris's traditional markets, there is little reason to believe that a new competitor will enter. It requires too much capitalization. Growth rates in the ORV market are no better than 5% year over year, and there is no reason to believe that utility vehicles and motorcycles will fare any better. New investment in this industry is simply infeasible at this time, and the best that can be hoped is capturing market share from competitors. Hybrid electric motive power does present several opportunities. Anecdotally, the current range of the best purely electric vehicle is 540 kilometers on a single charge. To be able to meet the demands of the average North American family on vacation, approximately 750 kilometers a day, will either require a 50% increase in range or halving the current supercharging time, approximately 30 minutes, and increasing the number of charging stations. The current lack of infrastructure in conjunction with range creates a scenario where the successful entrance of a single lone actor is minimal. The most likely scenario is the introduction of substitutes by premium branded companies with access to the capital and technological acumen necessary to threaten the consortiums which typify the manufacturing industry. Manufacturers utilize arm's-length relationships with suppliers to provide readily available generic resources. They also enter into relationships with what amounts to competitors to co-develop specialized vehicles. These relationships smooth component supply and demand, produce reliable quality, minimize expenses, ensure that R&D investment is directed appropriately, and provide access to new markets. Not all suppliers need provide physical components. There are relatively undercapitalized companies that are currently manufacturing quality products. These highly creative projects become the opportunity for larger firms to expand their engineering knowledge base. Evolving technology requires creative minds to drive it, and they are not always filtered into highly capitalized business models. It then becomes advantageous to support and continuously parse third-party sources to supplement the large-scale creative process. Having the necessary capital and ability to recognize talent produces opportunities which results in leading-edge accomplishment. Like their Japanese counterparts, Polaris's sponsorship of race teams becomes the means to gather field research, just as Daimler, BMW, and Renault-Nissan use automotive race series to refine their R&D investment. Industry leadership, then, requires the foresight to recognize opportunity both at the micro as well as the macro level, and forge strategic alliances so as to maximize the probability of integrating the next technological advancement into their respective markets. Considering the scope of Polaris's portfolio, any of the companies just mentioned are a threat to its markets. This is particularly the case with BMW and Daimler. Both are well capitalized, with the former having a solid motorcycle business, and the latter with the smart car and having made overtures to Ducati before Audi's purchase. Similar to the auto industry, powersport is a seller's market, with the caveat that in times of distress, extreme measures may be taken in the form of promotions. This eliminates consumers' ability to bargain for price. Individual dealers may have different levels to which they can discount, but manufacturers' prices are firm. This leaves consumers with the decision of whether to buy a new model, last year's with a promotion, or used. Large capitalization gives manufacturers power over suppliers. This is an extension of the arm's length manufacturing model. Generic components are outsourced to the most reliable in quality and logistics, and alternatives are always available. It is only when scarce resources and/or geopolitical risk create opportunity that suppliers are able to take advantage of this business model. This could easily happen in the electric motive power industry, as China, with its pollution dilemma and long-term mentality, has invested heavily into countries with large lithium deposits. Given that the state is at arm's length with most companies, should they manage to develop the industry appropriately, they could easily become a disruptive player in the market. Polaris has demonstrated their ability to effectively compete in their core markets. They have consistently introduced products and features that consumers have sought. They have faced their competitors publicly and dominated them. They have invested in their vision of the future and recognized the limitations of the present. These are the qualities of an industry leader. Polaris's board of directors consists of 8 members, one of which is Scott Wine, CEO. Every member is deemed independent, save Mr. Wine. The average age of a member is 57, and tenure on the board, 3. Average attendance at meetings is 75%. 2013 saw 5 directors being replaced and its size reduced to 8. And since then, 5 members have been replaced, 1 in 2014, and 2 in each of the subsequent years. Average remuneration is approximately equally split between cash and stock, with totals adding to $1.7 million between 8 members. Industry experience includes toys, manufacturing, electronic controls, engineering, energy management and automation, coatings, aircraft maintenance and repair, and finance. The composition of this board clearly favors Polaris's mandate. Polaris's last few years have been brutal, as CEO Wine lamented at the 2017 Q2 investors meeting. Soft demand, recalls of its top sport ORV due to fire hazards, and aggressive promotions by competitors to dump inventory. Throughout this time, Polaris has continued its long history of profit sharing with its employees. It has undertaken to increase worker occupational safety despite it being better than its North American competitors, but worse than the Japanese. It is also seeking to improve engagement of employees. These signal a fundamental understanding of manufacturing. A safe and engaged worker is more productive. There is no better method of gaining operating margin. Their M&A activity over the past 5 years has introduced higher margin products into their portfolio. They have implemented over 2,500 value improvement projects to channel $400 million of growth cost savings back into the company. This has been done by reorganizing its productive capacity, order-taking and tracking system, insourcing, negotiation of better pricing, global and local sourcing of upstream resources, extending and upgrading access to customer service and dealer training. Another $500 million in savings is forecast over the next 5 years by strategic sourcing of resources, improving quality and inventory utilization, and decreasing delivery time, both with respect to sales and new products. Capacity utilization is currently at 58% and is projected to reach 85% by concentrating on core markets. The high growth years raised the expectations of dealers. They became accustomed to quality products and service. Polaris has been their own worst enemy. Product recalls, lack of quality in powertrains, and failing to heed dealer voices has caused a reduction in their image. They have implemented a quality safety program to obtain performance data from the field. Once an issue is noted, a process is followed to determine and eliminate the source, whether it be in design, manufacturing controls, or with supplier quality. This should allow them to implement change more rapidly and be able to get a better product to market more quickly. The solution sounds simple and intuitive. Innovation drives growth and margin protection. Whether Polaris will be able to translate its R&D investments remains to be seen. In addition to posting new executives' employment contracts, the most recent investor meeting on July 26, 2017 indicates that management is committed to addressing issues by their investors, customers, dealers, and shareholders. This is predicated on being in an industry that is highly competitive, and therefore certain information is best kept secret. Management openly acknowledged their shortcomings, tried to moderate their enthusiasm, did not forward excuses, and provided a cogent analysis and plan to their audience in a genuine manner. Reminiscing, CEO Wine opened the analysts' meeting on July 20 with a remark which was remarkably candid, and I quote, "Recently, I had a conversation with one of our better dealers and was pleased to hear him acknowledge that we were listening to and addressing some of his concerns. Before I could stop smiling, he confidently asserted that he expected us to get back to ignoring him just as soon as we started winning again. These are the characteristics of those at the highest level of motorsport and should inspire confidence in their shareholders." CEO Wine refers to Polaris's capital allocation strategy as being boring. Their first dollar is allocated to fund the business, innovation, and building an efficient manufacturing infrastructure. Polaris believes in their ability to produce and deliver a product which their customer base appreciates. Investors will appreciate that they are 3 years away from being a dividend aristocrat, having increased their dividend for 25 or more years, and that their share count remains flat through buybacks. Their M&A strategy does not exist. Instead, their corporate strategy is to use their balance sheet to add opportunities for strategic growth wherever it makes sense. Polaris's ability to generate profits through innovation, strategic alliances, and sound organization indicates that they understand the growth potential in their markets and in the industry as a whole. Every employee has a reason to perform well at Polaris. Among other perquisites, factory workers can get an essentially free, though leased, demonstration unit after 1 year of service, have 5% of their 401k matched per pay period, and an annual bonus, 15 to 20%, which is dependent on profit levels. Executives must perform if they are to double their yearly salaries. 65 to 100% of salary, cash incentive compensation, 65 to 80% of salary, long-term incentive plan, stock options, restricted stock units, performance-based units which cannot be taken in hand until a specific time period, 3 years is the norm, and a mandatory share purchase, 60,000 shares for the CEO, 30,000 shares for the COO and CFO, and 15,000 for all other executive officers. There has been no significant executive trading in shares over the past year, save one who left the company. But overall employee ownership has declined from the 2016 mark of 10 to 9%, and down more from the 2013 high of 11. Key financial ratios for Polaris have been provided along with one of its competitors, Yamaha. The primary advantage that Polaris has is its consistent dividend. Yamaha has had a dividend for almost as long as Polaris, but it has been erratic in its declaration and growth. Polaris also gets a better return on its capital, but this is due to it being more highly levered. Although Polaris's price-to-book ratio is significantly higher than Yamaha's, It is 6% below its 25-year average, with Yamaha being close to 15% above its. Polaris has a Sharpe ratio of 0.77 and Yamaha 0.35. This indicates that Polaris rewards its investors over twice as much as Yamaha given risk. However, when compared to the consumer discretionary ETF, XLY, with a Sharpe ratio of 2.04, the ETF is by far the better choice. Polaris is a growth company with a dividend. Despite 4 negative year-over-year earnings events in its history, it has never failed to re-establish its earnings power within 2 years. It has a long history of dividend growth, and there are no signs of this changing. Through its acquisitions, it has become a brand with which to be reckoned. Through its ability to bring innovation to market quickly, it has won the respect of consumers and the military. Its electric segment appears well positioned to take advantage of future trends. Through its strategic alliances, it is positioned for growth in the largest developing countries in the world. Its iconic brand, Indian, is well positioned among millennials for future growth. The troubling fact is that its current core markets are growing at 5% at best, and 2016 was a negative year-over-year earnings event. Polaris will have to take share from its competitors by continuing to introduce technologically innovative products which appeal not only to veteran power sports enthusiasts, but to those whose lifestyle is augmented or business benefited by such an investment. Similarly, it will have to develop its international presence, but with the caveat that developing markets are less likely to be able to afford the luxury with which the Polaris brand is identified. Considering Polaris's record of being able to thoughtfully manage its brand portfolio and capture market share with innovation and style, there is little doubt that it will continue to expand its revenues in the future. However, given its negative earnings report for 2016 and lack of core demand growth, it is overpriced. Once it can signal that core demand is improving as projected, it will be a worthy investment.